Hey guys, today we're going to talk about taxable investment accounts. Okay, we went over the traditional IRAs and Roth IRAs and 401ks. This is just an account that you put money in. Think of it as a savings account that you can invest in different investments like stocks, bonds. There's some tax benefits of actually having an after-tax normal taxable account like this. Stepped up in cost basis. So for example, let's say you bought a great stock. Let's say you bought Apple 30 years ago, okay? And you've made a bundle of money in it, and now you're older and you want to leave it to your kids or grandkids. By not selling it, holding on to it, at your passing, as long as there's no, you don't make too much that you're over the estate tax part, you actually can get a stepped up cost basis at death. So you might be able to give that actual stock to your children without any tax complications if they were to sell it, which is really important. So if you hang on to it and you gift it to your kids at your death, you actually get a stepped up cost basis. So you might be able to give $1 million worth of gains in a stock if you did really well in it for zero tax complications. So it's actually a really good benefit there. You can't do that in IRAs or Roths. If you have losses throughout the year, let's say you have losses of investments. Let's say you bought a stock A and stock B, and stock B just didn't do very well. You can sell that if it's a loss, and you can actually offset any other gains you might have in that account from other investments. So that's a good benefit. So you can move your money around and actually might even have what is known as a loss deduction. So what that means is, let's say you have enough losses in this account that you have, it's basically $3,000 or more of losses in an investment account. You can actually use that loss off of your taxable income. So let's say you make $50,000 a year, you have money in an investment account, it was a bad year, you sell, and let's say you have more than $3,000 worth of losses, you can actually deduct that off of your earned income, so now you're only really claiming $47,000 that year. So that's good. And with unlimited carryover, what does that mean? So let's say you have a large account and you have, let's say you lost $20,000 in it. Okay, it's not a good time. It could be a recession. No one wants to talk about losses, but they happen. If you have losses, and let's say it's $20,000, you're going to end up having your $3,000 of losses that you can take for that year. So then in this case, you're going to have another $17,000 that's left that you can use for next year. So let's say we recover, your investment account has done very well, you've now made a lot of money, but you don't want to still own some of these stocks because you kind of want to de-risk it and move it around. You can still sell and use that $17,000 that you had to offset future gains. So there are some benefits to this. Some stocks, again, they pay dividends. You have interest from your bonds. You have capital gains from buying and selling the stock. Those are all going to be taxable, but they can be at a lower rate. So if you think back to like your 401ks and your traditional IRAs, anything you take out of those are going to be taxable as normal income to you. Dividends and capital gains, those are generally going to be taxed more favorably. Could be 15%. For some of you, if you're in the lower tax brackets, you don't pay tax on any of it, which is really good. So that can be a great way to put money away and not have to worry about paying taxes. So it all depends on your tax bracket, but usually these things will be taxed at a lower rate, which is nice. So there are some benefits there. You can also have multiple owners. So that's different. Remember, your IRAs are an individual retirement account. You can have multiple owners. It can be a single owner. It could be a joint between spouses. It can be multiple people. It could be a family account. It could be a trust account. It could be a company account. Okay. So a company can have their own investment account, okay? And you can invest any money. So for example, the IRA, you had to have earned income. You can have any income. This money can come from anywhere, okay, to invest in this. So basically you're looking at multiple owners, trustees. So they have complete control of this account. So you can have, just like the IRAs, you can have complete control of the different investments you have. Just like this, you have complete control over this, so it's not stuck to like a list. So you can buy any of these investments, just like the other ones, your stocks, your bonds, your mutual funds. And again, there's no limits on this. So, if you come into some money, you can put it into a taxable account. like this no matter what your income bracket is. It's just a good way to put money away, and there are a lot of different tax benefits that are good for taxable accounts. So that's about it.